It's been a little while. I mean, it's been a few weeks. It's been a weird few weeks.
At least a few weeks.
Yeah. Well, and it's not just us. I've talked with lots of people, and it's like, it's been pretty busy. I feel like everybody's jamming to try and get everything done that they have to get done before everything goes dark after Thanksgiving.
Yeah, there's definitely not, I don't think, a reason for me that I could say why things are so busy. Sometimes you say, oh, it's tax time or it's year-end planning stuff. You usually could pinpoint it, but I would just feel like, yeah, it's been busy. Time's gone by and we've just haven't been able to connect to do it.
It's not just busy for us. It's busy for clients. It's busy for people we work with. I know the tax extension filing, people who file an extension had their filing deadline just earlier this week as we're recording this at the end of the second or third week. Is this the third week of October?
This is the third week.
Technically, even though,
yes.
Okay, we'll call it the third week. Anyway, whatever. The extension filers had their deadline earlier this week. So that was kind of big. I don't know. It's just, it's an interesting time. I think everybody's kind of gripping a little tighter as we get a little bit closer to the election. So,
one month from now, not even a month from now, just a few weeks from now, and we'll be past that and focusing on something else as well.
Yeah, on to the next crisis du jour. So, that leads me to my opening question for you, Ryan. Who are you voting for? No, I'm kidding. I'm not asking that question. Are you kidding me? No, not at all. I don't care. I don't want to know. I don't care. Let's just dig right into it. All right.
All right. Let's go.
Okay. All right, everybody, welcome back to the Financial Insights Casual Friday Financial Insights podcast. Years later, still not doing that right. My name is Brian Ullman, a financial advisor here at Ford Financial Group, joined by Ryan Louie, also a financial advisor here at Ford Financial Group. And together we, as often as we can, get together, answer questions that we get from clients or talk about some of the issues that we have found are relevant for clients in their financial planning and investing purposes. We keep it at a high level, though. So if you have questions as you listen to this that are maybe more specific to your situation, you can reach out to one of us. You can email our firm, info@fordfg.com, and we'll be happy to forward your question on to your advisor, answer your question ourselves, set up a time to chat, have a cup of coffee and a second opinion on what your investments are doing. You get the idea. If you're listening to this podcast, the audio podcast, you can subscribe wherever you're listening to it, Apple Podcasts, Spotify, etc. If you're watching this on YouTube, you can subscribe to our YouTube channel. We do this, but we also will post kind of client-related stuff from time to time, depending on what's going on. It's been a little quiet here lately. Ryan, you want to dig in, talk about what's going on in markets? It's been quiet. Things have been quietly moving higher, right?
Stocks have been continuing the trend that we've really kind of been on, for the majority of the year. Yeah. We're making new highs in the markets overall, which definitely benefiting people's portfolios. Bonds have been a little bit different, I think, over the last few weeks, more so than the stock market as a whole.
Yeah.
But if we were to take a big picture for the calendar year, it's been bonds up, stocks up.
Yeah, I mean, it's been true of both. Interestingly, the NASDAQ was doing better. Tech stocks, you could argue, were doing better than the S&P 500. But that changed as we got into late July, early August. And we've talked about this already, but August, we had a really big downdraft where some of the indices, really fell almost not towards break even, but gave up half of their gains, if not more than that. And really since then, the S&P 500 has outpaced NASDAQ. Just by the makeup of it, the S&P 500 is tech heavy. But you can see, especially with the Dow getting better here lately, the rally has been broadening to not just include kind of technology focused stocks, but other names as well. This is something
I think we would prefer to see at this point.
Sure.
Broadening, it's not just, 5, 7, 10 different stocks that are leading the way and everyone else is kind of not doing a whole lot. It feels a lot better, I think, overall for people's portfolios, because we're not just involved in those companies only, that, other stocks are doing well now as we get later into the year.
Yeah, we talked earlier this year about how the market had bad breadth, which was the bad joke to go along with it. And the Magnificent Seven is a name or a term that we've all heard of ad nauseum for the last year. We're talking about those big names. I won't list them, but the big names. And so we have better breadth. Things are catching up. You can see the yellow line are small company stocks, or the Russell 2000, starting to kind of come into its own here with a rally here lately. And then the green line here are bonds up a little bit. This is the aggregate bond index, which is a pretty broad measure, but up in positive territory after spending really the first half of the year in negative territory. This all has to do with rising, or with interest rates falling, doesn't it?
Right. I mean, the two investments that probably are most interest rate sensitive were flat to negative at the halfway point of the year, as you can kind of see through these charts, the green and yellow line. And then as, maybe it became a little bit clearer, the market started to favor that interest rates were going to come down. Bonds went up, small caps went up, and they're sitting with, decent gains at this point.
Yeah. It's been a nice change after bonds have been getting thumped. So that's where we've been. The question now is, where are we headed? Before we jump into the slides here, we've got some slides this week from BlackRock, which is an investment firm that you might have heard of. They're one of the big fund providers. Sometimes you hear good and bad. I think bad from people who misunderstand what firms like BlackRock, Vanguard do. You've probably heard this, Ryan, that they own everything. Well, really, no, they're an investment vehicle for all of us owning everything, but that's okay. The Fed's going to meet in the 3 week, couple days after the election. We're not going to handicap the election, but what do you think about the Fed? Are you still on for a quarter?
I would think so. I think my inclination really comes more from the fact that they lowered interest rates last time. I don't know. I wonder what the history is. I mean, has there been a time where they've done one interest rate, rise or cut and then continue to do it, And so that's I lean towards momentum playing into this. I know that there was an inflation report, I think, that wasn't so great, but I don't think it's enough to stop the momentum. And again, they don't want to make it look like they're wishy-washy with their decision making either. Yeah,
we didn't tee up the Federal Reserve slides and the interest rate slides necessarily for this episode, but it's still the what they call the neutral rate is still well lower than where it's at right now with the Fed. Unemployment has improved. So we went from 4.3% to 4.2 to 4.1. Importantly, not a whole lot of layoffs. And so maybe the Fed doesn't really need to worry so much about jobs. I don't know. We'll see. I think they're probably still on for 0.25%. Let's jump into your first slide, because this is one from BlackRock, as I mentioned. The title here: bonds have become a less reliable hedge in the new regime. You pick this one out? What are you saying here?
Yeah, I think there's really just kind of two things to kind of take away. One is that I think most people will think of bonds and stocks as, bonds can help you or help be the rock in your portfolio during rough times. And we spent a period of time, and what this chart's showing is kind of a longer term history with the orange line, 1980 to 2019, so almost 40 years. And then the more current regime, 2021 going forward. And what you want to see is that bonds go up, when the stock market goes down. And then that's why they become your rock. And you can see that in with these orange boxes, they did a very good job for about 40 years and a little bit less so the last several years. Now, my takeaway is this. This is, I believe that we are going back to a time of the orange bars, not the yellow bars. I think that we spent a little bit of time with these yellow bars because in 2022, the market was going down. And a good portion of 2023 was rough too for the first 9-10 months. And so when the markets were going down, the bonds were in a environment where interest rates were going up, so they were going down. So yeah, they were both going down at the same time a lot for many of these periods from 2021 to 2022, 2023. Yep. And as we go forward, where we're no longer in a rising interest rate environment, I think the bonds act more normally. So I do think that we spent a period of time where, the yellow bars are the yellow bars. That was just it for a couple of years. But I think we are going back to the previous 40 years where they start to do their job again.
Yeah, I'm with you. I think this just shows how wonky bonds have been here very lately. But the orange bars are a sample size of nearly 40 years versus a sample size of 3. So I don't think this is a really honest comparison. Nothing is BlackRock. I just think the purpose of this chart is to point out how bad or wonky bonds have been over these last couple of years. And I agree with you. I think we've got some normalization in store.
I think this is good from a standpoint of, like there's a bit of probably recency bias where people will say, man, bonds didn't do so great for me when the stocks market were going down. And I think the takeaway from this chart is if we're going back and away from this very small period of time and going back to these orange bars, I think that they will do their job. So let's not let this very small few years in the past, distort what we think is going to happen going forward.
Yeah, no, I think that's a good point. I think that's a really good point. We'll talk a little bit more about bonds. I've got a couple slides that relate to bonds as well. But your other slide here has to do with equities, and this slide BlackRock has here.
Like what
equities are going to broaden.
Yeah, kind of what we were just talking about before, right? We've been so enamored with the large technology companies carrying all the weight of why the stock market has gone up. And there's been many discussions of like, when is it going to be the turn of other stocks, other companies to start participating in the stock market gains? One way to look at it on a very, very broad level is on the left-hand side chart. You can see US versus world ex-US. Which is developed minus the U.S. And then you have the green line, which is emerging markets. This has been probably a discussion I think people have had on and off probably since the financial crisis of, when will international start to do better? And I don't know that there's an answer to that, but there is definitively a gap between the performance of international investments versus the U.S. equity markets, right? And so I think that the case continues to be they are cheaper and therefore they have potential on a value basis to move upwards in comparison to how far and how much we've gone up over the years.
Yeah. I think I think as we go forward, we're going to start to see things. I mean, it almost feels like it's still coming off of COVID, right? Or you just have all these just weird abnormalities going on, and yet tech is driven a lot, but there's so much room for everything else to grow that we could get, we could see it.
Well, even if you're just looking at the U.S., because I know that most people are more focused on the U.S. versus, wanting to overweight international or emerging markets. But on the right-hand side, you could kind of look at the yellow bars being the past 12 months earnings versus the next or the expected 12 months future earnings. And you can kind of see where technology at the top, there's not much of a difference between the past earnings and what we expect the next 12 months to be. It's just, slightly higher. But in a lot of the other cases, earnings are expected to be a lot higher in the next 12 months for them than what they've been earning in the previous 12 months. And so if, they start to again, momentum behind their earnings start to really, play out. You could see some of these different sectors start to really improve.
Yeah, this chart doesn't suggest that other shoe is going to drop somewhere that I think a lot of people, after a good run that, what goes up must come down. That's the way I hear that so often, and it's not necessarily the case, right? If we're looking forward here.
For sure.
Yeah. Okay. So these are some positive charts, if you will. It's not so much that it was positive that bonds weren't a good diversifier to begin with in the last chart, or in these last couple of years. But I think as we look forward, it paints a pretty decent picture for both bonds and stocks that on these charts that you've chosen from BlackRock. Mine are a little bit different. We have so much money has been flowing into money market funds, and a money market fund is a really secure kind of bond alternative, cash alternative, high yield cash, so to speak. And it's been interesting. As interest rates are coming down, people are still interested in money market funds. And I think because even though on a money market fund, if the 1 year yield isn't 5.25%, but like 4.8, that's still attractive to some people. And so I think this has been interesting to see kind of what happens after interest rates start to fall. And so this chart here, money market yields are poised to fall and bond funds continue to outperform cash. Really, this is looking at the 15 largest bond categories and how on the right-hand side, how money market has fared compared to other bonds in the last almost 2 years. So this is January of 2023 through the end of September. And as you might expect, money market funds pretty low because all they're doing is giving you falling yield as opposed to appreciating in value. So I guess it's not too much of a surprise here. And then what was interesting to me really on this slide was the left-hand part, which is to say the average money market yields after several cuts. And you can see here, like in early 2001, the first Fed fund rate cut, and then yields on money market cratered. Same thing with September 2007, cratered. When they started to cut in August of 2019, back to zero. I don't know if we're going back to zero, but man, it's like yields fall off a cliff.
Yeah, I think, part of this is maybe it's a little bit of interest rate cuts that happen initially, followed by some kind of recession or crisis that happens that really extends it. It's possible that if you see on the far left-hand side of the chart, in 1995, there was a little bit of cut and it kind of just, wibble wobbled its way for quite a while. That's probably a more likely possibility. I mean, again, if you think that a recession is coming, and we've talked about this, and that happens in 2025, it is definitely possible we see another instance where interest rates, fall off the edge of the cliff again because they're going to try to resuscitate the economy. But if we kind of just have a decent economy, it might go down a little bit and then just kind of muddle along. Maybe similar to 95, definitely maybe more similar to 95 than any of these other instances where it just almost goes to zero.
Well, I mean, presuming that's the one cut in this chart that wasn't accompanied by crisis.
Yes.
If anything, it was accompanied by a balanced budget from Congress and the president at the time. So yeah, maybe that's a better way to look at this, is saying, hey, yeah, yields go down, but the last four, well, I don't know. 2019, there was no crisis necessarily. I mean, COVID came on.
They started the cuts, and then it was followed by COVID to knock the rates all the way down to zero.
So it was the proximity, and the time proximity is too close. The other one, again, for me, was money market. I think I can understand this one, and it goes back again. This is the last rate, these last few rate decreases. How long it took for people to find their way out of these money market funds after a rate cut. And so I'll start on the right-hand side again. In 2001, the first Fed rate decrease, money market assets actually peaked 2 years later, and then started coming down. It was 15 months after 2007, and it was 9 months after 2019. I think your analysis, Ryan, from the first chart may apply here, but it's interesting. People look and say, oh, the yields are, I think people look and say, oh, the yields are good, I'll take it. And they're not quite as good, and then not quite as good. And they hang in there for a little while because they say, oh, well, the yields aren't as good as they were, but they're still pretty good. So I'm going to hang around here. I think
that's like two camps, right? Like the one camp may be the one that says, I was getting 5, let's say, and now I'm at 3. And so therefore I got to do something else just because I'm no longer even close to 5. And then there might be the other person that says, I'm getting 3. I was getting 5, but I'm getting 3, but I got no place else better that I want to put this money that's safe. And so it's the best thing that's still around.
Yeah. It depends if this kind of investment for a person is an alternative to being in the market or is an alternative to being in cash. Right. Correct. And if you're getting 2 nickels on your cash, 3 or 3.5 or whatever % in money market is still better than that. And so maybe that's why it hangs around a little longer. If the markets are ripping higher, you may get some FOMO and people find their way out, and it takes some time to do it. I don't know. It's just interesting. It seems pretty clearly that there's interest rates, the yield, when interest rates start being cut, the yields on money market fall and can fall pretty quickly, as we saw these last few times. But even though yields fall quickly, it doesn't mean people move quickly, which is, I don't know what the takeaway is from this, but there is definitely some lag between rate cut and rates falling on yields, or yields falling on money market, and people actually doing something about it. which suggests to me it's a cash alternative, not an investment alternative. But
yes, I think if you're right, because I think if it was an investment alternative, you would see money leave pretty quickly, just because people would say, "I want to go get something else."
Yep.
Again, if I was earning 5 and now I'm earning less than 4, even, I want to go seek something else that's going to give me a lot higher return, which means you're probably at some point going to need to go into something that's riskier, right?
Yep.
And so yeah, this is safe. I think that people treat most of this as safe money.
Which is good. It's nice to get yields on safe cash alternatives. All right. Well, that's it for charts today. What's on your mind this week?
So I'm 2 weeks away from going to New York with the family, and other than making reservations for the hotel and the flight, we haven't done a whole lot of research and filling in the time. Sunday, while we're there, my wife's running the New York Marathon, so that's right. Pretty much booked in terms of what we need to do for that day. But I definitely need to start filling in some of the other days and what we're going to do. My wife will veg out on Saturday and not leave the hotel room because she doesn't want to use up her legs. So I will take the boys out and try to
go full tourist.
Find to do something that maybe she's not interested in because she won't be there, that the boys are interested in. So I got to start figuring out my itinerary very shortly.
Use ChatGPT.
Yeah,
do an itinerary for me for 4 days in New York, whatever it is.
Yes.
There you go. Or at least that could be your starting point.
Excited though, just because I think this is the sweet spot for going there. It's not it's not the summertime where it's very humid and kind of hot, nor is it winter when it's freezing cold. So I'm excited for that, because I don't think I've been there at this time of year.
I think you and I were there this time of year, 2008, in 2008.
No, because I think
we were there right as Bear Stearns was starting to fail.
Oh, you're right. It was September. September.
Maybe it wasn't fall.
I might have said like August, September, something like that.
Yeah, because we caught a baseball game while we were there, so it was still baseball season. Anyway, well, that's cool. New York is awesome. Hopefully, it's not as crowded also with the timing here that you guys are going.
Sure.
So that's cool.
No, it'll be busy. It's the New York Marathon.
Yeah. There is an event going on. That's for sure. Well, that's going to be awesome. That's going to be really, really cool. I have a couple of things on my mind. One of them I talked about already. They said Spotify has audiobooks if you're a subscriber to Spotify. And it's like, I bought a book, started reading it, and then I was looking for something else on Spotify and it was recommended to me. The book that I just bought was a free audiobook on Spotify. So what was on my mind is on my mind again. It's like, man, I really need to check the audiobooks on Spotify to see if I can save myself some money as I'm reading.
What do you prefer though?
I prefer to read.
Okay.
But I prefer to save $15. So
I'd see the alternative too is sometimes like it may be even easier to get through the book if it's audio, because you could be doing something, driving, something else. And so maybe for like a preference of just getting through the book.
Yeah. I feel like I can read faster than I can listen though.
Okay.
So I don't know, but I'm still marveled that so many of these books that I read or want to read are available for free. Well, I mean, as part of your Spotify subscription. But the other thing that's on my mind is that I've got a new gadget, so to speak. Whoop band. Have you had a Whoop band before?
Okay,
Brian? Yeah.
What are you trying to get from that you wouldn't get from your Apple Watch?
Nothing. I like the Apple Watch better. But what I've begun doing is actually wearing a regular watch.
Oh, I get it.
And so I still want my data. I want my steps. So I've had it for a day or two. So nothing's calculated. You kind of got to wear it for, I think, a month. You've got to sleep with it on, which I hate doing. I hate sleeping with.
I don't sleep with my watch. I have an Apple Watch.
No, me neither. But I'm going to do it for the sake of experimenting and see how it goes. So that's my latest fitness data efforts here.
So let me ask you this. So what made you go to a normal analog watch?
I've been at as the weather's cooled off, there are more fundraisers, there are more gatherings. We'll be headed towards Christmas parties. And when I'm dressed nicely, I don't necessarily want to wear my Apple Watch, my fitness watch.
Yeah.
And so, I didn't break the bank, but I got a nicer watch that I can wear. That's a little bit more dressed up than just wearing the Apple Watch.
That makes sense.
But as I wear it, I want,
you want
I don't want to lose my stand and steps. And there was an update to the Whoop band that started counting steps. It didn't used to do that. So, I don't know. Jury's out. This could wind up being a waste. I'm going to try it for a few months and see how I like it and see how it goes. And so I'll check back with you maybe after the first of the year if I'm still wearing it.
Okay. Yeah.
Yeah.
Or if you're back with the Apple Watch, we'll see.
Well, I still wear my Apple. I wore them. Yeah. I worked out this morning and wore both, believe it or not. So this is true overkill, but I want to get to a place where I'm not stuck with just wearing one watch all the time.
Yeah.
And so we'll see. I don't know. If you go online, there's mixed reviews on Whoop and how it goes. And none of this tracking stuff is really, but this is more health stuff, trying to stay in shape, I've lost quite a bit of weight and trying to keep it off. And so having you and I are data guys.
Yeah.
Numbers. I want to see
accountable, right?
Yeah. I want to quantify it, you know? So that's what's going on there. Anyway. All right. We'll leave it there. It's markets just closed. S&P Dow just closed at record highs. So we'll leave it there for today. And Ryan, we'll crank out one of these again, maybe hopefully before the election, certainly after the election.
Sounds good.
All right. Talk to you then.